Heya Cryptozens, it's 10 p.m. Pacific time. The date is October 20th, 2022. Welcome back to the Crypto Overnighter. My name is Nikodemus, and I'll be your host as we take a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. And keep in mind, nothing in this show should ever be considered financial advice. Caroline Wilkins is a Bank of England Financial Policy Committee external member. So she's a central banker. And it's her view that the current lack of regulation is more than just bad for business, that the current lack of good governance means a lack of consumer protection. She sees it as an existential threat. And so it was that on the 19th of October, she gave a talk at the University College London Centre for Blockchain Technologies. And in the course of that talk, she said decentralized finance would be a good place to start. She said of all of the complaints about scams that make it to the level of the Financial Conduct Authority, most of them involved crypto. So that risk is substantial, as is the reputational risk. And she's not the first person to talk about this, but she sees how the concentration of voting power in DeFi is a source of risk. Additionally, there are concerns about accountability. Just think about the situation with UkiDAO. They don't know who the players all are in that DAO, so they just laid out a blanket order. And here's where we really get to the crux of it. She said, quote, "We live in an inherently uncertain world. That means there can never be a set of smart contracts for every situation, and centralized decision-making will always be needed when the unexpected happens." So those decisions are getting more complex because she said that crypto better watch out. She was talking about traditional finance catching up by adopting blockchain technology. And we've seen that, right? Okay, here's an example. You ever hear of the JPM coin? If not, don't beat yourself up too much. It's not something you can just pick up at an exchange. It has a special purpose internal to JP Morgan. From their website, quote, "The JPM coin isn't money per se. It represents US dollars that are held in designated accounts at JP Morgan Chase. In short, a JPM coin always has the value equivalent to $1 US. When one client sends money to another over the blockchain, JPM coins are transferred and instantaneously redeemed for the equivalent amount of US dollars, reducing the typical settlement time. So it's like their own private stablecoin. I see that as an example of TradFi trying to catch all of the advantages of crypto without giving up any of the control. Wilkins said, quote, "Regulated firms in traditional finance are increasingly applying the underlying blockchain technology to traditional capital markets. They will be in a better position to capture this market if crypto industry does not get its house in order, if only because they have more familiar and battle-tested governance." Now, one example Wilkins mentioned was JP Morgan's Onyx blockchain trading network. Fidelity is another example, and we'll talk about them in a minute. Anyway, she recommends, quote, "industry-led mechanisms that develop codes of conduct and best practices, regular code audits, and disclosure of how rights to change the code are determined and who holds the commit keys." But that was only part of her message, because Wilkins had more to say. She seemed to be saying that decentralized finance isn't all that decentralized. She said, quote, "Concentrations of power in proof of work and proof of stake systems and other flaws in governance of crypto and DeFi have already contributed to two familiar issues. Top of the list are business failures, illegal activity, and financial losses for investors." And that is something that she says could erode at the trust that investors need to have in crypto-based financial systems. So here's one of the issues that she brought up. Of the top 50 proof-of-stake platforms by market cap, the top 10 validators hold 47 to 100% of those stakes. So she's saying that while the government gets to work fixing the regulatory and legislative space where crypto is concerned, industry needs to get to work. She said private industry and DeFi investors need to do more to protect their projects and digital assets. She said, quote, "It is in the interest of the private sector to be more proactive. major investors must get up, stand up to demand change. It is critical that industry adopt best practices and codes of conduct to reinforce trustworthy behavior and culture. Okay, so let's bring this back home, because DeFi is making its rounds legislatively here in the States. What I'm talking about here is the Digital Commodities Consumer Protection Act, or DCCPA. Now, this bill has elements that crypto advocates said would kill DeFi. Well, that has been updated, which is good for DeFi because the previous version had been panned heavily. One reason is the definition of the term digital commodity platform. Now, some folks took a look at that definition and said it could be seen as a ban on DeFi. The advocacy group Alliance DAO called it a DeFi killer. They said the bill, quote, creates a compliance architecture that precludes the concept of a system of smart contracts operating decentralized infrastructure with little or no reliance on human activity. And that's because it required people to enforce those regulations. So they've posted a new bill, a 31-page draft. Gabriel Shapiro of Delphi Labs said he made this bill available because he believed in, quote, transparency and open discussion. And he pointed out a section that changes the meaning of the term digital commodity trading facility. And this is such a huge change, because this new version excludes software developers and software publishers. So the guy who writes code for a protocol is exempt from these regulations. And it has been noted by observers on crypto Twitter that this is similar to the same regulations in the UK and the EU. One said that the United States is, quote, finally getting their act together. That said, even with the current problems, the US is still adopting DeFi. Currently, America accounts for more than 37% of DeFi volume. That puts the United States ahead of any other country. This comes to us from a report by Chainalysis. And in that report, they note that the United States' Bitcoin dominance has gone down. That's also more than any other country. In the year between July 2021 and June 2022, Bitcoin's dominance dropped 6%. They attribute that partially to an increase in DeFi more than anything else. According to DeFi Llama, there's more than $53 billion of assets locked in DeFi ecosystem, which is down by more than $100 billion since the start of the year. That said, the U.S. still accounts for more than 37% of all DeFi activity. Western Europe, as a region, was next with 31%. Out of everything, the decentralized exchanges counted for most of the value received. They also tend to be used by more institutional and professional investors. Now, make no mistake, most of that traffic comes from NFTs. So it looks like NFTs are the gateway drug for mainstream consumers to get into DeFi. Reddit is an example. Their collectible avatars NFT project has brought in more than 3 million new Web3 users. Now, as far as volume goes, the U.S. accounted for more than $1 trillion last year, which means 1 of every 5 crypto transactions involved an American, statistically speaking. And if you look at what they're working on these days, they're building to reduce financial pain points. These are things we talk about often on this show, and they're bringing these solutions we talk about as well. They're working on things like mortgages and digital identities, and the tokenization of assets. One of the most important considerations where DeFi is concerned are the stablecoins. Martin Gruenberg is the acting chairman of the Federal Deposit Insurance Company. It's his view that U.S. regulators need to start working on the requirements for stablecoins to make sure that they fit in the U.S. banking system rather than disrupt it. He was giving a talk at the Brookings Institute when he seemed to be channeling the frustrations of all regulators. Quote, as soon as the risks of some crypto assets come into sharper focus, either the underlying technology shifts or the use case or the business model of the crypto asset changes. New crypto assets are regularly coming on the market with differentiated risk profiles such that superficially similar crypto assets may pose significantly different risks. So what he's saying is it's hard to regulate crypto because it changes so much so often. It's like nailing Jell-O to a tree. Now, to combat this, he's saying that the FDIC is working to gather relevant information to get a handle on the industry. He also said that customers and institutions needed to have a better grasp of what the FDIC is and how they work. And his opinion matters because the FDIC is a U.S. banking watchdog. Their opinion is going to weigh quite heavily when it comes time to write stablecoin regulations. Now, right now, we have financial institutions offering crypto services. Fidelity is one of those, and like I said, I'll get to them in a bit. But Gruenberg and his agency have been watching this. He said they've been cautious about letting regulated lenders get involved in offering crypto services. One of the things that he pointed out is that any stablecoins will need to be compatible with a system that we've talked about before on this show, FedNow by the Federal Reserve. It's a real-time payment system set to debut next year. Now, in addition to working with FedNow, he said any stablecoins need to complement the potential for a central bank digital currency in the United States. He said, quote, "The development of a payment stablecoin could fundamentally alter the landscape of banking." He also said that stablecoins could change the way credit works with banking, quote, "possibly leading to forms of credit disintermediation that could harm the viability of many U.S. banks and potentially create a foundation for a new type of shadow banking." So we should keep in mind, Gruenberg, he doesn't seem to be a big fan of crypto. One of his arguments is that the industry so far is just focused on trading. He said, quote, "Thus far, we haven't seen much evidence of benefit. It remains to be demonstrated whether there's some potential here." He said that there's 3 ways to make stablecoins safe. 1, to have them offered through bank subsidiaries. 2, to have them backed 100% by T-bills. And 3, put them on permissioned ledger systems. And it's not just pick one of these. He's saying you need to do all 3. He said, quote, "The ability to know all the parties, including nodes and validators, that are engaging in payment stablecoin activities is critical to ensuring compliance with anti-money laundering and countering the financing of terrorism regulations and deterring sanction evasion." Now, overall, he sees the possibilities presented by stablecoins as mostly negative. And that's even if they were covered by prudent regulation, backed by treasury bonds, and keeping them on permissioned ledgers. Now, I promised you we would talk about Fidelity. Here we go. Fidelity Digital Assets sent a letter to their clients. This is the crypto wing of Fidelity Investments. Now, they're offering Ethereum custody and trading services later this month. And as is sometimes the case, this is for institutional investors, the big guys. So, according to an email sent, quote, "Institutional Ethereum capabilities will be available to institutional investors starting on the 28th of October. It read in part, quote, "With the Ethereum merge completed, many investors are looking at Ethereum through a new lens." Now, some people thought maybe the shift to proof of stake was what encouraged Fidelity to bring down this program for Ethereum. I don't believe that to be true. Fidelity has long been a supporter of Bitcoin. In fact, they put out a paper saying that they felt Bitcoin was not just technology, but a superior version of money. Last April, they announced that they were setting it up so that their accountants could use Bitcoin to directly invest in a 401k savings account. And this may be because last year, 90% of their biggest customers said that they were interested in Bitcoin and other cryptos. This is after an announcement of a new Ethereum index fund. Now, what it says is that Fidelity will be facilitating buying, selling, and trading Ethereum, quote, "using the same model provided for Bitcoin investments today." Now, we've spoken on the show about Kyle Roche and Roche Freedman. Remember, Kyle was caught on tape confessing to filing lawsuits against companies. And the reason for these lawsuits weren't specifically to win cases, at least not just that anyway. No, they allegedly filed those suits with an eye towards discovery. They'd require all sorts of sensitive information like customer lists and emails and things like that. And then they would take that sensitive information over to their buddies at Ava Labs. Now, this was all revealed in videos that he made while he was drinking in a bar, bragging about his work, allegedly. Now, Roche Freedman represents 5 plaintiffs in the Tether Benex class action lawsuit. But they don't represent all of them. And counsel for the other plaintiffs in this case petitioned to have Roche Freedman removed from the case. And that happened. The judge removed Roche Freedman from the case 6 days ago. Well, it seems like Kyle Roche has removed himself from the firm that he helped found. Now, this new firm is going to be called Freedman Norman Friedland. And they confirmed Thursday that Kyle was no longer with the firm. In a statement, they said, quote, "We wish Kyle the best in his future endeavors." Now, this comes after Roche maintained that the leaked tape was full of false statements made by him. He said it was, quote, "obtained through deceptive means, including a deliberate scheme to intoxicate, then exploit me." Meanwhile, in other legal news, Hodlonaut, known as Magnus Graneth in MeatSpace, Hodlonaut won his case. A Norwegian judge ruled in his favor over Craig Wright. Now, this was an attempt to avoid a defamation suit. Wright was planning on suing him in the UK, because in the UK, the laws around defamation are heavily skewed in the favor of the plaintiffs. And in the UK, those damages can be huge. At issue is a series of tweets, and they were written by him in March of 2019. Now, keep in mind, Craig Wright has long claimed that he is Satoshi Nakamoto. Hodlonaut called Wright a fraud and a scammer, and that was the whole point behind his suit. He went to court to get a judge to say that his words were protected by the freedom of speech, because if this speech is protected, that means Wright can't sue him over it. Hodlonaut said, quote, "The result was as expected. I am very happy and thankful for all the support." Now, Wright's attorneys, they disagreed. They said Wright would be appealing the ruling, and they said that any anonymous online bullying could have a chilling effect in the public square. I got to say, I think Wright is in a really bad spot here. Not only is he out some $400,000 or so to pay for Hodlonaut's legal expenses, that judge really hurt his chances for any future cases, because the judge said it was fair for Hodlonaut to call Wright a scammer and a fraud. And that's where we're leaving things tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.